Welcome to the Pro Ticker Deep Dive.
It's good to be here. And it is a fascinating, if somewhat disorienting day to be analyzing the markets.
Disorienting is the right word.
Yeah, if ever there was a time to just sit down, block out the noise, and really look at the machinery underneath the headlines, it is right now.
I couldn't agree more. It is Wednesday, February 11th, 2026. And I have to say, looking at the screens this morning, the signal-to-noise ratio is completely out of whack.
It's just all noise.
It's all noise. If you are just casually glancing at your phone notifications or watching the ticker tape scroll by at the bottom of a screen, you might be scratching your head. I mean, we are looking at a day of massive, almost violent contradictions in the financial landscape.
He is more than just a mixed bag. You hear that phrase a lot, but that feels too light, too cliched for what we're actually seeing play out. We're witnessing a genuine bifurcation.
Bifurcation.
A split reality where two completely different, totally opposing narratives are happening at the exact same time.
Right. Because on one hand, you have the headline number that everyone likes to quote at cocktail parties, the one that makes the evening news. The Dow Jones Industrial Average.
The big one.
It just crossed a major psychological barrier today, hitting a record high over 50,000, specifically 50,188. That sounds like a party. That sounds like a booming, unstoppable economy.
It sounds like everything's great. Pop the champagne.
Exactly. But then you simply look slightly to the left at the other indices, the ones that are arguably more representative of the broader economy and especially the growth sectors. The S&P 500 is sliding. The NASDAQ is sliding.
And not just sliding a little bit. There's real weakness there. So you have this core tension where we are seeing record highs in the, let's call it the old economy industrials, the companies that build things, sell tangible goods, clashing with some very real, very palpable jitters about the future.
Jitters about what specifically?
Jitters about the future of technology, the stability of credit, the actual health of the consumer, and just the broader economic horizon. It's a fundamental disagreement about what the next 12 months look like.
So our mission for this deep dive is to try and figure out why the market seems to have developed this split personality disorder. And looking through the research we have for today, it feels like we aren't just looking at stock prices moving up and down a few basis points due to normal fluctuation. It feels structural.
It is structural,
Yeah.
and I don't use that word lightly. We are witnessing a convergence of risks that usually don't happen all at once. It's like three different weather fronts colliding over the same spot.
That's a good way to put it.
And it's confusing investors because it's a fundamental rebasing of the operating system of the global economy.
Huh.
I mean, think about it. We are talking about a major shift in who runs the Federal Reserve and what money actually costs.
That's a big one.
A huge one. Then you have how artificial intelligence is moving from this, cool tech novelty to actually eating into the earnings of the service sector. And on top of all that, you have the geopolitics of computer chips in the South China Sea. Any one of those is a major story.
And they're all happening now.
All at once.
It's a lot to take in, so let's try to unpack this systematically. We've got a few main themes to get through to make sense of today. First, what you've been calling the war shock, a massive shift in monetary philosophy that's rattling the cages of, well, gold bugs and bond traders alike.
Yeah, that's the foundational piece. It changes the price of everything.
Second, we need to discuss what is being called a Darwinian transition in tech and, maybe more acutely, in healthcare.
Which is a fascinating development because we are seeing a major rotation. Investors are fleeing the visionary companies, the story stocks that promise the world in 10 years, and they are piling into the boring ones.
Boring but profitable.
Boring but profitable, the ones that pay you cash today, not in a decade.
Third, and this one is my favorite, we have the burger barometer.
Yes.
McDonald's earnings are out today, and as strange as it sounds, the price of a Big Mac and the foot traffic at the Golden Arches might actually be a better, more real-time indicator of the U.S. consumer than the government's own data.
It's the ground truth. It tells you what people are actually doing with their last $20.
Exactly. And finally, the big, scary one that's always lurking in the background, the $10 trillion shadow involving Taiwan.
That is the tail risk. The low probability, high impact event that, frankly, algorithms are struggling to price in because the consequences are simply too vast to model effectively.
It's the black swan event everyone is terrified of. Okay, let's jump right into the deep end then. Segment 1, the macroeconomic paradox. We have to start with the data that dropped this morning, the January Employment Situation Report.
This was the catalyst. This was the spark that lit the fuse for the morning's volatility.
Mhm.
To understand why this report mattered so much, you have to understand the consensus view going into 8:30 a.m. this morning.
What was the expectation?
The entire market, I mean everyone, was positioned for a cooling labor market. The forecast, the median estimate from economists, was for employers to add about 75,000 jobs.
Which would have been a Goldilocks number, right?
Yeah.
Not too hot to force the Fed's hand, but not too cold to signal a recession.
Exactly. A number like 75,000 or even 80,000, it sort of whispers to the Federal Reserve, hey, the economy is slowing down just enough to be safe, but not enough to crash. It's safe to start thinking about cutting interest rates.
It's the soft landing narrative that everyone has been hoping for.
That's the dream scenario, but
Right.
that is not what we got, not even close. The report came out and employers added 130,000 jobs.
So they almost doubled the forecast.
They smashed the forecast. It wasn't even in the range of possibilities for most analysts.
And on top of that, the unemployment rate dropped too, right? It fell unexpectedly to 4.3%. Now, for the listener who isn't glued to the financial news cycle every single day, usually more jobs is good news. It means people have paychecks, they can buy groceries, they can pay rent. Why did the market choke on this good news?
Because we are in this very specific and kind of perverse part of the economic cycle where good news is bad news for asset prices. This robust data, that 130,000 jobs number, it removes any and all urgency for the Federal Reserve to cut interest rates.
So the punch bowl stays away for longer?
The punch bowl is locked in a cabinet, and the Fed has the key. Look, the market was pricing in a rescue operation. The narrative was that the economy was slowing, and the Fed would have to ride to the rescue with a rate cut to save a slowing economy. Instead, it got resilience. And resilience means rates stay higher for longer.
It's the no landing scenario we've heard about. The plane isn't landing softly or crashing. It's just staying at 30,000 feet, burning fuel.
Correct. And if the plane keeps flying that fast, the pilot, in this case, the Fed, has no reason to ease up. They have to keep the brakes on to make sure inflation doesn't flare up again. But there is a second layer to this report that I think is even more significant than the headline number.
Okay.
And this is the part that really shocked me when I dug into the footnotes of the Bureau of Labor Statistics released this morning. It wasn't on the front page. Buried in this report was a massive revision for the entire year of 2025.
I saw that and I had to reread it to make sure I wasn't seeing things. They revised the 2025 job numbers downward.
Drastically, catastrophically, you could almost argue. This is where the story gets really murky. Previously, the government data, the numbers we were all operating on for a full year, told us the economy added 584,000 jobs in 2025.
And that was the narrative we lived with. That was the data businesses used to plan hiring, that investors used to build models.
It's the data the Fed used to make policy, the revised number. Only 181,000 jobs for all of 2025.
Wait, pause there. Let's really let that sink in. That is a disparity of roughly 400,000 jobs. That's not a rounding error. That's not a small adjustment. That's the entire population of a mid-sized city like Minneapolis or Tulsa just vanishing from the employment data.
It completely evaporates. It changes the entire narrative of the last 12 months. It suggests that the underlying momentum of the U.S. economy was far, far weaker than we thought while we were actually living through it.
So we were making decisions based on a false premise.
We were effectively flying blind, making investment decisions, hiring decisions, and policy decisions based on data that was overstating the strength of the economy by a factor of 3. It's a staggering revision.
That is deeply unsettling. So what we have now is this weird two-speed reality. The historical data has been revised to say, hey, 2025 was actually pretty rough, barely growing, but the brand new January 2026 data says, just kidding, we're booming again with 130,000 jobs. It has to create a crisis of confidence, doesn't it?
It creates statistical fog. How can you trust the new number when the old numbers were so wrong?
Yeah.
Investors don't know if they can rely on the reported growth figures. If the 2025 numbers were that far off the mark, who's to say the January number isn't wrong too? Maybe it'll be revised down to 30,000 jobs a year from now.
Or maybe it'll be revised up to 200,000. The uncertainty is the killer.
The uncertainty is the killer. And when you add that uncertainty, that fog, to the new variable at the Federal Reserve, you get the kind of volatility we are seeing today.
Okay, let's talk about that new variable. You called it the Warsh shock.
Yes. The nomination of Kevin Warsh as the next Federal Reserve Chairman. This is arguably the biggest driver of the market instability we saw earlier this week, particularly in the commodities market.
Now, for those who don't follow central bank biographies for fun, who is Kevin Warsh? And why does his name scare the gold market so much?
So Kevin Warsh is a former Fed governor. He was there during the 2008 crisis. But his reputation now is as a reformed hawk.
A reformed hawk. What does that mean in practice?
To really understand his impact, you have to look at the regime change he represents. The last few years, really since 2008, but it's been accelerated recently, have been defined by liquidity. Easy money. If there is a problem, the Fed prints money. If stocks fall, the Fed lowers rates. We call this the Fed put.
It's the idea that there is a safety net. The Fed will always step in to put a floor under the market to prevent a crash.
Exactly. It's an insurance policy for investors, paid for by the central bank. Warsh is the antithesis of that philosophy. He is known for disliking liquidity at any cost. He has written and spoken extensively about how he believes that all this easy money creates moral hazard, it creates asset bubbles, and it keeps zombie companies alive that should have gone bankrupt.
So he's the adult in the room who wants to take away the punch bowl just as the party gets going?
In a way, yes. He represents a fundamental shift toward rigid valuation discipline. He wants the Fed to have a smaller balance sheet. He wants a more deregulatory stance. But crucially, and this is the key point for the markets, he is seen as a staunch defender of the currency. He wants a strong dollar.
And the market heard that message loud and clear.
Oh, immediately. The market reacted to this potential philosophy shift, and we saw what can only be described as a flash crash in precious metals.
I saw the numbers. Gold was down 10% in a single day. Silver was down something like 30% over a short period. That's a crash you usually only see in speculative cryptocurrencies or penny stocks, not in, centuries-old stores of value.
It is a massive, violent unwinding of what we call the debasement trade.
Can you explain that trade?
Sure. For years, people bought gold and silver and other hard assets as a hedge against the government printing too much money. They were basically betting that the dollar would lose value, that it would be debased, because there was just so much of it being created out of thin air.
It's an inflation hedge.
It's an inflation and currency devaluation hedge. If Warsh is coming in with the stated goal of tightening the money supply, stopping the printing press, and protecting the purchasing power of the dollar, that entire trade collapses overnight. There's no need to hedge against a crashing dollar if the dollar isn't going to crash. In fact, if the dollar is going to get stronger, you want to own dollars, not things that are priced in dollars.
And we saw that play out in the currency markets, too. The U.S. dollar index, the DXY, it rebounded significantly. It's sitting around 96.60 now.
Which has enormous global implications. It tightens financial conditions globally. If the dollar is stronger, it's harder for emerging markets to pay their debts, which are often denominated in dollars. It pressures U.S. exporters because their goods suddenly become more expensive for the rest of the world. It's a wrecking ball in some ways.
But for the listener, what's the key takeaway here in terms of the Fed's next move?
The key takeaway is in the rate expectations. The market has completely repriced the path of the Fed. The prevailing bet now is that the Fed holds rates steady through May. A cut isn't seen as likely until June 2026 at the earliest.
That feels like a lifetime away for investors who just a few weeks ago were hoping for a March cut.
It is a lifetime in market terms. And that higher-for-longer environment, supercharged by the Warsh nomination, forces investors to look at companies completely differently. This is the crucial pivot point. Look, when money is free, when interest rates are zero, you can speculate. You can throw money at story stocks that might maybe make a profit in 10 years. It doesn't cost you anything to wait. The opportunity cost is zero.
You're not giving up any return by holding something that doesn't pay you.
Exactly. But when money costs 5% or 6%, when you can get a guaranteed return from a treasury bill, you can't wait. You need cash flow now. You need dividends now. The future gets discounted much more heavily. A promise of $1 in 2035 is worth a lot less today when you can get 6 cents on your dollar right now, risk-free.
Cash is no longer trash. It's a real asset with a real return.
Cash is king again. And that changes everything.
Which transitions us perfectly to segment 2. Because if there is one sector that has been driven by stories and future promises lately, it's AI. But today, we aren't talking about AI stocks booming. We are talking about an AI shock in the financial sector specifically.
Yes, this is a fascinating development that I think is going to be a case study in business schools a few years from now. This morning, we are seeing a sharp, across-the-board decline in financial service stocks. We're talking about the big wealth managers and brokerages. Charles Schwab is down about 7%. Raymond James is down 7%. Stifel is down 6%.
And to be clear, this isn't because they had bad earnings reports, right? They didn't miss their numbers or issue weak guidance. This is an external shock.
That's right. This isn't about their performance last quarter. The catalyst is a product launch. a new tool called Hazel, which was just launched by a fintech company called Altruist.
Hazel. It sounds so innocuous, friendly even, like a helpful librarian.
Don't let the name fool you. This represents a significant potential threat to the status quo, and the market is reacting to that threat. Hazel is an AI-powered tax planning tool. It can ingest and analyze complex tax forms, create personalized tax loss harvesting strategies, and do all the complex portfolio math in minutes.
Now, let's contextualize this for everyone. That is work that usually takes a human financial advisor hours, sometimes many hours, to do. And arguably, that complexity, that specialized knowledge, is how they justify charging their 1% annual fee on assets under management.
That is the fear. That is the entire ball game right there. The market is asking a very simple, very existential question this morning. If a chatbot can do the complex tax planning and portfolio strategy in 3 minutes for a fraction of the cost, why am I paying a human wealth manager tens of thousands of dollars a year?
It's the AI replacing the white-collar worker narrative that we've been hearing about for a while. We've seen it with writers and graphic designers, but this feels more tangible. It's not just writing a poem, it's doing the specific high-value math that pays the bills for an entire industry.
It strikes directly at the profit margin. Jason Wenk, who is the CEO of Altruist, was quite blunt in his press release. He said this tool makes average advice a lot harder to justify. And we have to be honest with ourselves. In the financial world, average advice is a multi-billion-dollar industry. Many advisors are essentially asset gatherers who rely on basic allocation models and software. If AI can commoditize that core function, their margins are at serious risk.
But looking at the stock moves down 7% in a single day is a violent move for a big brokerage stock. Is the market overreacting here? Is this a panic?
Well, many analysts certainly think so. You have voices from Morningstar and from Citizens Bank coming out and arguing that this sell-off is overdone. Their argument is that AI, at least for now, is a tool for efficiency, not a tool for replacement.
So it's an Iron Man suit for the financial advisor, not a Terminator sent to kill them.
That is the bull case. That's the counter-narrative. The argument goes that the best advisors will use Hazel to do the grunt work faster. This frees them up to spend more time with the client, doing the uniquely human things, the hand-holding during a market crash, the behavioral coaching, the complex estate planning with family dynamics, the stuff a chatbot can't do.
So it's the competition versus extinction debate.
Exactly. And for the next few years, it likely does fit into the pattern of competition. It helps the incumbents who adapt and use the new tools. But markets hate uncertainty. They see a new technology, and they immediately try to price in the worst-case scenario. They price in the Kodak moment.
The idea that these legacy wealth managers are about to become obsolete, just like film cameras did when digital arrived on the scene.
And that's the panic you're seeing today. Is Schwab the new Kodak? The market's saying, maybe, and selling first, asking questions later.
It feels like this specific event with Hazel is part of a broader reevaluation of AI happening right now. It's not just buy everything that says AI anymore. The market is getting much more discerning.
Oh, absolutely. The hype phase is over. We are shifting from AI as a destination where you just buy a stock because it has an AI wrapper on it to AI as infrastructure.
Could you distinguish that for us? What do you mean by an AI wrapper?
An AI wrapper is a company that essentially just puts a nice, friendly user interface on top of someone else's powerful model, like OpenAI's GPT or Google's Gemini. They don't own the brain, they just own the skin.
And that's not a defensible business.
It's a completely defenseless business model. Anyone can copy it in a weekend. AI as infrastructure means investing in the companies that have the actual defensible moats, the companies that have proprietary data that no one else has, the companies that make the chips, the companies that own the data centers and the power plants, or the ones with the infrastructure-grade models that actually run the world.
So investors are dumping the fluff and looking for the concrete, the picks and shovels of the AI gold rush.
Precisely. We even saw European markets decline specifically because of these same worries. The fear is that these powerful new AI models will shrink profit margins for traditional software businesses. If AI can write code, what happens to the company that sells coding tools? If AI can design a marketing plan, what happens to Adobe? It's a powerful deflationary force on the price of software. If the output becomes nearly free, the companies selling the tools to create that output lose their pricing power.
It's ruthless out there. Speaking of ruthless, let's talk about segment 3. You called this the Darwinian transition in health tech. That sounds pretty intense.
The healthcare sector is undergoing a massive bifurcation. It's survival of the fittest, playing out in real time on the ticker tape. The capital environment has changed, and it's forcing a separation between the haves and the have-nots.
So just like in the broader market, we are seeing some clear winners and some very clear losers today. Let's start with the winners. Who is winning?
The titans, the safe havens. A company like GSK is up nearly 7% today, hitting 26-year highs. Think about that. A 26-year high for a giant old pharmaceutical company. AstraZeneca is another one that's performing very well.
Why them? As you said, they aren't exactly the exciting, high-growth tech disruptors we usually talk about. They are the dinosaurs, in a sense.
That is exactly why they are winning right now. In this market environment, being a dinosaur is a good thing. They have strong, predictable dividends, they have real earnings, they have robust drug pipelines. In a world where the war shock is making capital expensive and uncertain, investors want safety. They want cash flow.
You want to check in the mail.
They want to check in the mail. GSK growing its core operating profit by double digits and increasing its dividend makes it vastly more attractive than a speculative biotech firm that might run out of money in 18 months.
Okay, so let's talk about that other side, the losers. Who is on the flip side of the Darwinian trade?
The so-called disruptors are bleeding. The big one today is United Health. The stock is down 19%.
19%. For a company the size of United Health, I mean, it's one of the largest companies in the world, that is a massive destruction of value. We're talking about tens of billions of dollars wiped out in a day. What on earth happened?
It is a combination of factors. And what's wild is they actually beat their earnings expectations. But the market looked past the headline beat and focused on the internals, specifically their struggle with medical utilization costs.
Translate that for us. Medical utilization costs. What does that mean for their business?
In simple terms, it means people are going to the doctor more than expected. They are getting more surgeries, they're filling more prescriptions, they're getting more knee replacements, especially seniors. For a hospital or a patient, it's not necessarily a bad thing, but for an insurer like United Health, every procedure is a cost. Their medical loss ratio, which is the percentage of premiums they have to pay out in claims, is climbing.
So their costs are rising unexpectedly.
And if they pay out more in claims than they budgeted for, their profits shrink. The market is now terrified that this trend is not a one-off, but the new normal, and that their future earnings are at risk.
And then you have other companies like Oxford Nanopore, which is a classic, innovative biotech firm. They're also down significantly.
And their story is simpler. They are burning cash. So if you are a company that is losing money, the market has zero patience for you right now. None. The era of venture-subsidized growth in health tech is over. You can't just burn hundreds of millions of dollars chasing a dream anymore.
So what does the market demand now?
The market now demands what you might call rational exuberance. You need an infrastructure grid business model. You need proven reimbursement codes from insurers. You need a clear path to profitability. You can't just have a cool science experiment and expect investors to fund you indefinitely.
There's another factor at play here too, right? A political one. The Kennedy effect.
Yes, we absolutely cannot ignore the political dimension. The appointment of Robert F. Kennedy Jr. as health secretary is having a tangible impact on investor sentiment in this sector.
And what happened specifically to trigger this recent move? What was the event?
The event was that the FDA, under this new leadership, declined to review Moderna's application for a new mRNA flu vaccine.
Wow. Regardless of the science, a decision like that sends a chill down the spine of biotech investors.
It's a massive red flag. It introduces regulatory risk and what some are calling a trust gap. Investors are now scared of unpredictable policy shifts, especially regarding vaccines and new approval pathways. If the FDA becomes more unpredictable or even perceived as hostile to certain technologies like mRNA, the risk premium on those stocks goes through the roof.
Investors start asking, why should I take the risk of investing hundreds of millions in this drug's development if the regulator might just arbitrarily block it at the finish line?
That is the exact question. It throws a wrench into the entire valuation model for a huge swath of the biotech industry.
So let's connect these pieces. If you are a big pharma company, one of those titans like GSK, and you're facing a patent cliff, I read a staggering statistic that $300 billion in revenue is set to expire by 2030 as patents run out. What do you do in this environment?
You go shopping. You buy. M&A mergers and acquisitions is the lifeline. Big Pharma needs to refill its pipeline because, as you said, their blockbuster drugs are going off patent. When a patent expires, cheap generics flood the market and that revenue collapses almost overnight.
So they need to buy new drugs from smaller companies.
They have to. But, and this is the key, they will be very picky shoppers. They will only buy the smaller biotech firms that have de-risked assets, the ones that have already navigated the regulatory maze. So again, quality wins. They won't buy the early-stage science experiments. They will buy the companies with approved drugs or late-stage trial data.
It really is Darwinian. The weak get culled and the strong consolidate power.
That's the playbook for 2026.
Okay, moving to segment 4. We've talked macro, tech, health. Now let's talk about something we can all relate to. Lunch. The burger barometer.
McDonald's. Ticker symbol MCD. A bellwether, if there ever was one.
They are reporting earnings today. And I have to ask, why does a fast food company matter so much in a deep dive about global economics and AI?
Because McDonald's is a unique economic indicator. It's a real-time pulse check on the health of the consumer, specifically the lower to middle income consumer who is most sensitive to inflation and economic stress. It's a proxy for disposable income at the household level.
And we know from other data points that the consumer is shaky right now. The retail data that came out recently for December was not good, was it?
No, it was weak, very weak, virtually unchanged from November and up only 2.4% year over year, which is less than the rate of inflation for many goods. The commentary from analysts was that spending surely stalled. The narrative is that consumers bought what they needed for the holidays early, maybe in October, and then just stopped. They hit a wall.
And if you look at the balance sheet of the American family, it makes sense. Total household debt just hit $18.8 trillion.
That is a scary, scary number. It's an all-time high, not just in nominal terms, but in real terms for many families. Credit card delinquencies are ticking up. Auto loan delinquencies are ticking up. The savings buffer from the pandemic is long gone.
So when we look at McDonald's earnings, we are looking for evidence of the trade-down effect.
Yes. The trade down. Explain the psychology there for our listeners.
The logic is simple. When times are tough, your budget gets squeezed. You stop going to the $50 a person sit-down restaurant. Then you stop going to the casual dining chain like Chili's or Applebee's where it might be $25. And you trade down to McDonald's where you hope to get a meal for under $10.
So paradoxically, a recession can be good for McDonald's business. And that's why its stock is near 52-week highs. It is seen as a defensive play.
But there is a tension there, isn't there? A real contradiction. Because I recall reading that low-income consumer traffic at McDonald's has actually dropped in previous quarters.
That is the critical tension. It's a value war. McDonald's has raised its prices significantly over the last few years to combat its own inflation in food and labor costs. We've all seen the viral receipts online for the $18 Big Mac meal.
Which used to be the definition of a cheap meal.
Exactly. So the core question for the company and for the market is this. Have they raised prices so much that they've lost their core customer, the one who is literally broke and needs a $5 meal? Can they sustain growth just by charging more to the people who still come? Or do they need to return to deep discounting like the old dollar menu to win back that lower income demographic they've lost?
So we're looking at their margins versus their traffic. Analysts are expecting earnings per share of $3.02. If they hit that number, what is the signal the market takes from that?
If they hit that, and more importantly, if their guidance for the next quarter is steady, it reinforces McDonald's as a defensive anchor in a portfolio. It tells us that even if the broader economy is slowing, the big established players with massive scale can still find ways to make money. It fits the broader theme of the day: safety, quality, infrastructure.
It's funny, we are talking about high-tech AI that can reshape industries and bioscience that can cure diseases. But at the end of the day, investors are hiding out in burgers and drugs.
It is a flight to simplicity and predictable cash flow. When the world feels complex and uncertain, you buy what people need. They need to eat, and they need their medicine. You don't buy what they might want in 5 years if their stock portfolio doubles. You buy the here and now.
Speaking of complexity, we have to address the elephant in the room. Or perhaps the dragon in the room. Segment 5, the geopolitical shadow.
This is the backdrop for everything else we've discussed. You can look at PE ratios and earnings reports and cash flow statements all day, but geopolitical risk is the one thing that can override all of it in an instant. It's the unknown unknown.
I read this absolutely terrifying Bloomberg report that came out, the $10 trillion fight. It models the economic impact of a blockade or invasion of Taiwan.
The numbers in that report are staggering. They're almost hard to comprehend. We aren't just talking about a regional conflict with tragic human costs. From a purely economic standpoint, we are talking about the destruction or blockade of Taiwan's semiconductor fabs, the fabrication plants where the most advanced computer chips in the world are made.
If those go offline, what happens?
If those fabs go offline, The modeling suggests a $10 trillion hit to global GDP.
Let me just repeat that. $10 trillion. That is worse than the 2008 financial crisis and the pandemic combined.
Much worse. Because there's no vaccine for a lack of chips. There is no central bank bailout. The entire global AI industry, everything we discussed in segment 2, every data center, every phone, every modern car, every military system, the cloud, it all runs on these specific advanced chips that come overwhelmingly from one island, from Taiwan. This is the ultimate tail risk.
A tail risk being an event that has a very low probability of happening on any given day. But if it does happen, the consequences are catastrophic.
That's it. And that is why we call it a flux point. The algorithms that drive so much of modern trading struggle to price this in because, well, how do you price the end of the modern economy as we know it? If TSMC in Taiwan goes dark, the valuation of Apple, Nvidia, Microsoft, Google, it becomes a purely theoretical exercise. Their business model ceased to function.
So the market mostly ignores it day to day until it can't. But while that is a hypothetical future risk, we have a very real present risk happening with China and its holdings of U.S. debt.
That's right. This was the news that Chinese regulators have reportedly instructed major banks to limit their purchases of U.S. treasuries and, in some cases, to actively reduce their holdings.
Their stated reason is risk diversification.
Correct. They want to reduce their concentration risk to the U.S. dollar and U.S. debt. But in practice, you have to think about basic supply and demand. If China, which has historically been one of the biggest buyers of U.S. debt, stops buying or even starts selling, that floods the market with an excess supply of treasury bonds.
And when supply goes up, prices go down. And for bonds, when prices go down, yields go up.
And that is partially why the 10-year treasury yield, which is a benchmark for borrowing costs across the economy, rose to around 4.17%.
So let's connect the dots for the listener, because yields can sound abstract. China sells U.S. debt, that pushes yields up, and because of that, U.S. mortgage rates go up, car loan rates go up, borrowing becomes more expensive for the American homeowner and the American business.
That is the direct transmission mechanism. It also makes borrowing more expensive for the U.S. government itself, which has to finance its massive deficits. It creates a tightening of financial conditions without the Fed doing a single thing. It's a silent hike. It acts just like a rate hike from the Federal Reserve, but it's being initiated from Beijing.
It really feels like a pincer movement. You have the war shock potentially tightening financial conditions from the inside. Our own Fed wants tighter money. And you have these geopolitical shifts with China tightening conditions from the outside.
And then you layer on top of that the constant friction in the Middle East. We had reports of U.S.-Iran tensions in the Strait of Hormuz after a drone was downed, which caused oil prices to tick up to near $70 a barrel. The recent Munich Security Conference report warned of the unraveling of the entire post-war transatlantic security framework. It's a messy, messy world out there.
So let's try to tie this all together. What does this all mean? We've covered a lot of ground here. We have strong labor data that is actually bad news because it prevents rate cuts. We have AI disrupting jobs and stocks in the service sector. We have geopolitical friction raising borrowing costs and energy costs. And we have a clear investor pivot away from hype and towards hard assets and cash flow.
If we synthesize all of this, I think we are in a period of searching for equilibrium. The market is trying to find solid ground after discovering that the map it was using for the last year was fundamentally wrong.
So what is the playbook here? If I'm a professional investor listening to this, trying to navigate this fog, what am I taking away from this deep dive?
I think the playbook is becoming clearer, but it requires discipline. It's not a get-rich-quick market anymore. First, you have to prioritize cash flow resilience. You want to own companies with recurring revenue. That's why the titans in healthcare are winning. You want the dividend that gets paid no matter what. You want companies that make money now, not companies that have a great story about how they're going to make money in 2030.
Okay, so resilience first. What's second?
Second, look for what we can call labor substitution plays. These are the companies that sell the automation, not the ones getting automated. If companies are firing people to buy AI software, you want to own the company selling the AI software.
Own the shovel, not the gold miner who's getting replaced by a machine.
Exactly. You want to be on the right side of that disruption.
And finally,
hedge with infrastructure modes. This goes back to our AI discussion. Data center power, advanced hardware, the companies that own the physical backbone of the digital world, the things AI needs to run. And in your personal portfolio, stay defensive. Think consumer staples, managed care, the things people can't stop buying even in a downturn.
So after years of chasing growth at any price, Boring is beautiful again.
For now, boring is safe. And in a volatile world where the rules are changing, safety commands a very high premium.
Before we sign off, I want to leave the listener with a final thought. And this one has been bugging me since we started, going all the way back to that first segment on the jobs report.
Go on.
It's that massive revision in the jobs data. The fact that the government came out and said, oops, our mistake, 2025 was actually way worse than we told you it was for an entire year. We were living through 2025, making decisions, thinking the economy was creating nearly 600,000 jobs. But the reality was it was creating less than 200,000.
It is a deeply disturbing realization. It implies a fundamental failure of measurement at a time when accurate measurement is more critical than ever.
It just makes me wonder if the data we rely on is that foggy, if the rearview mirror is that distorted, and the geopolitical risks on the horizon, like Taiwan, are that high $10 trillion high, are we actually flying blind into the rest of 2026?
It is a valid fear. If the dashboard of the car is broken, how do you know how fast you are driving or if you're about to run out of gas?
Maybe this volatility we are seeing today isn't a glitch. Maybe it isn't irrational. Perhaps it's the only rational response to a world where the safe assumptions we've all operated on, like U.S. debt being risk-free, or global supply chains being stable, or government data being accurate, are maybe no longer true.
That is a sobering thought. But it emphasizes why critical thinking and this kind of deep analysis looking past the headline to the revision in the footnote are more important than ever for anyone trying to navigate this landscape.
Absolutely. Stay curious, keep digging, and always, always check the footnotes. Thanks for joining us on the Pro Ticker Deep Dive.
Thank you.